Good morning from our global headquarters in New York. I'm Manus Cranny with Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Trade tensions. Treasury Secretary Janet Yellen tells Bloomberg that China retaliation against U.S. tariffs is always a possibility. Anglo-American exits diamonds in platinum in an effort to fend off a takeover bid from rival BHP. Plus, the Qatar Economic Forum kicks off in Doha. We have exclusive conversations with global leaders in business and government. Good morning, Manus.
Danny, good morning. I've been waiting for a long time to say this, but Roaring Kitty is back, and so those meme stocks fly. Keep an eye on GameStop and AMC, up 70% yesterday, up another 30% this morning. So is meme stock mania back? We'll talk more about that in a moment. There's your GameStop, up 39% pre-market. I just sort of like this story. It's just all a bit bonkers. Somebody appears on X and bang, these stocks go bid like mad. There's AMC up 38%. 10-year yields, we're going to see a little bit more narrative around what's happened. Yesterday, we saw the New York Fed inflation expectations for 1 year and 5 years. So the short term and the medium term spike a little bit higher. That unseated the bond market a little bit ahead of the PPI, the retail sales, and the CPI. That compilation narrative along with some of the other retailers. Bonds are down by a tick this morning. JGBs, they are all feeling this momentum higher in terms of yields, certainly on 30 years, a decade high there. So the question is the next move from the Bank of Japan? They pulled back on some of the QE, the bond buying that they did yesterday. Is the next move a shorter, sharper move higher in rates earlier than the market had anticipated? It's not supposed to be this way. This is all about closing the yield gap. Danny, good morning.
Good morning, Manus. We have some breaking news to go through. We had been expecting this, and we have indeed got it. President Biden is hiking tariffs on things like Chinese chips, minerals, and EVs. The changes, Manus, they're going to impact about $18 billion in current annual imports. I know you have some of the specifics with you, but this is more targeted than what Trump has proposed, which is a 60% flat tariff from Chinese goods.
Indeed. So this is pretty much in line with reporting that we had over the weekend, which was electric vehicles are going to go to 102.5%. We know that selling EVs for China here was always going to be difficult. They're already at 27.5%. That goes to 102%. Aluminium and steel, Danny, goes to 25%. So again, this goes back to what Terry Haynes said over the weekend, which is this is a lot about noise. But it is about an unsettling future in terms of the landscape, the geopolitical landscape. You're going to see them raising tariffs on ports, cranes, medical products, and increases on steel and aluminium, as I said.
Yep. So now we have to debate what is symbolic, what is actually impactful. Let's do that with our very own Bill Ferries. Bill, good morning to you. So we have these plans from President Biden. He's going to talk about them more in detail in a speech today. What about them do you see as symbolism versus actually impactful?
Well, that's exactly right. It is a broad swath of imports that we're talking about here, but some of them are purely symbolic. As Manus mentioned, the tariff on EVs, Chinese EVs coming in 102.5%. That's a big headline number. They're currently, I think, at 27.5%. But as you two know, you cannot buy a BYD or other Chinese electrical vehicle in the United States at this point. So that is very symbolic. What's interesting is some of these other ones, including the 25% tariff on chips, and then on port cranes, on medical equipment, including PPE. These were things that the U.S. badly needed and ramped up imports of during the COVID pandemic. But President Biden's goal here, what the White House is saying, is that they want to really give a boost to domestic manufacturing. Frankly, they also want to send a political message. And what we heard from National Economic Council Chair Lael Brainard was that her quote was that China is too big to play by its own rules. But again, it's all happening in the middle of a political campaign, and that is really the big context looming over all of this.
Yeah, and just to quote Terry sort of specifically at Pangea, he says, it's about the signal. The high geopolitical risk is reshaping U.S. economic policy. And we're all distracted with the Fed. So it's like, look over here, and perhaps there's something more malevolent over there. We caught up with the Treasury Secretary Janet Yellen yesterday, and she spoke to Bloomberg about taking major retaliatory steps against China.
President Biden believes that anything we do should be targeted to our concerns and not broad-based. And hopefully we will not see a significant Chinese response, but that's always a possibility.
it's my favorite saying, but the road to hell is paved with good intentions. So they're hoping it won't be a scalable response from China. Is that likely? Is it just going to be tit-for-tat drama?
Well, I think the key word there from Secretary Yellen was significant response. Listen, as you mentioned, we're talking about $18 billion in imports. The U.S. imported over $400 billion in goods from China last year, so a relatively small amount. If I would expect some kind of a response for sure from China, even though they knew this was coming. Janet Yellen signaled it to the Chinese when she was visiting the country, I think a month or 2 months ago. So this is not a huge surprise. We're getting the details now. But yes, I think China will make some kind of a response. But as Janet Yellen said right there, will it be significant? That's going to be the big question. It may be more symbolic, like some of these tariffs the Biden administration is proposing now.
Yep, certainly. Bill, appreciate it. That's Bloomberg's Bill Ferries. And perhaps because this was largely expected, not too much of a reaction from markets, basically where Manus first flagged them to start the morning. But should investors be pricing in a changing global order? Marvin Barth, founder of Thematic Markets, writes, the biggest threat to the global economy this year comes from intensifying geopolitical disorder, or what I've termed global entropy. Marvin joins us now. So Marvin, here we go again. Yet something else to add, perhaps, to global entropy. What is it, and why are we not as concerned as we should be?
So global entropy, very, very simply, is what a lot of people have called the fracturing of the post-war liberal order. And it's been going on for 30 years, but it seems to have really accelerated in the last year or so. And, you know, I would take a very different view of those trade sanctions. They're not symbolic. They are exactly part of an ongoing, undeclared, non-kinetic war between the U.S. and China. Yeah, you're not importing a lot of EVs now, but the point is you don't want to, and you're trying to protect industries that you feel are critical in times of national emergency, including warfare, by the way. That you want to develop in the U.S. So these are basically infant industry protections to try and develop those industries in the U.S.
Marvin, good morning. Danny came in this morning and she said she opened your blog and she went, oh, Marvin's taking a bit of a turn, a dark turn. So how dark is the turn? Because you talk about Fed policy error, expanding global disorder, direct confrontation between the U.S. and China. What is the most manifestly real issue, and how, or what is the most pragmatic hedge that I can afford without squandering cash?
Yeah, Manus, look, you know that I've been perhaps the most bullish analyst out there, and right, about the last several years. I said, we're going to get much higher interest rates because the economy is going to boom and everything's going to be fine through that. This year, I see so many different things coming together that are non-economic, the only one of which is, you know, perhaps the Fed and its potential policy errors being economic. That's what's really scaring me. And, you know, I think on the geopolitical front, the key issue is, if you look at this global entropy that's been taking place over 30 years, it's been a slow, gradual process. In the last year, 2 years, we've seen, you know, an invasion of a state in Europe. We're seeing a potential war in South America. We are seeing increasing risks of a war in the Pacific. We see the potential for Israel and Iran to get into an all-out war. This is showing you that global entropy has gotten to a point where actually things are potentially becoming chaotic, i.e. you're going to start to see nonlinear developments there. Okay. And I would also say that you should think about these as linked events. So how do you hedge those, I think, is the key question.
Okay, so tell us, Marvin, because in the world you're describing, I mean, you have here 10% odds of World War III. I'm reading this, Marvin. I said this to Manus this morning. I'm almost like, who even cares about financial markets at this point? It's almost apocalyptic. Yes. So, I mean, what do you do with that?
Okay, so I think, you know, the way you have to approach this is almost looking at like a venture capitalist, right? You know, a venture capitalist is going to bet on 10 different things that most of them they know are going to fail, but they're only going to invest in things that if they do pay off, they're going to pay off so big, they're going to pay off for the rest of the portfolio. And that's effectively the process you need to do here. And right now, options pricing, swaptions pricing, volatility pricing in general is so incredibly cheap. We're at near historic lows that actually essentially, you can go out and buy a lot of these options and build a basket of them that maybe all of them aren't going to pay off. But you can pay 1% of your portfolio value and still get like 10, 20 times payout that would offset a significant loss on the rest of your portfolio. Those opportunities are out there right now, but they won't last forever, so you should be grabbing them.
And you are particularly focused, I'm trying to distill a pretty meaty blog, but you are particularly focused on the post-election period, not just because of potential political, social issues, but also around the reversal of the Fed. Quantify the closing period, November 7th through to Deck 31.
Yeah, I'm actually much more worried about before the election. If you look at volatility pricing, everybody thinks the election is going to be this big issue. I'm not actually that worried about the particular election. We've had both of these presidents before. This is not a surprise. What is more of an issue, I think, is that the Fed keeps telling us that they don't have to worry about inflation. It's going to come down. We're going to get another signal, I think on Wednesday, CPI comes out. Core inflation is now running at 4.5%, more than double the Fed's target. Okay? They are not going to be able to backtrack. We're much more likely to see a hike rather than a cut.
Well, Marvin,
and I think that's going to be a surprise for markets.
And you write partially the reason they're not doing it is because of politics. Jim Bianco, I think, laid this out really well. There's a difference between being political and partisan. Which do you think the Fed is being right now?
No, Jim has it exactly right. Look, I'm a former Fed economist. I can tell you the Fed is not a partisan political animal. I don't think anyone there is thinking we want, Democrats versus Republicans or vice versa. But what I do think that they're thinking is that they probably first of all, I think this is based in their own inherent beliefs about the economy, but that's being augmented by, I think most of them probably are scared of the idea of Donald Trump as president. And so if they can try to avoid that, they'd like to, and it fits with what their models are saying. So I don't think it's an explicit or even conscious political bias, but it comes out in their policy.
Okay, Marvin, we have a lot to chew on. Try and take a brighter road, Marvin.
I wish.
A bit of weight off those shoulders.
It's too deep in.
Because that blog was heavy going. Marvin, always great to see you and get your take.
You.
That is Marvin Barth of Thematic Markets. Other stories trending on your Bloomberg terminal this morning. This is what we've got for you. French President Emmanuel Macron says he'd be open to seeing a major French bank being taken over by an EU rival to spur deeper integration. Macron spoke in an interview with Bloomberg News editor-in-chief John Micklethwaite on the sidelines of Choose France summit in Versailles.
Dealing as Europeans means that you need consolidation as Europeans.
So it could be cross-border mergers in both directions.
This is a totally new world, and we do need this new business model for the Europeans. More innovation, more investment, single market and capital market union, and a relevant trade policy.
U.S. Secretary of State Antony Blinken arrived in Kyiv earlier today. He's there to reinforce U.S. support after delays in billions of dollars of military aid prompted fears that the U.S. would abandon its partner in the face of Russia's invasion.
Poland's president says Russia will launch additional attacks if its forces aren't prevented from victory in its war on Ukraine. Duda spoke with Bloomberg at the Qatar Economic Forum in Doha.
We must not allow that Russia wins in Ukraine. Once again, let me repeat. The free world must not, I believe, allow Russia to win the war in Ukraine.
Speaking of the Qatar Economic Forum happening right now in Doha, Bloomberg's Jomana Bercecci is speaking to the finance ministers of Qatar and Saudi Arabia, as well as the chairman of the Islamic Development Bank Group. If you want to tune into this, you can go and watch on LiveGo on your terminal.
Comes to fiscal sustainability, for the country.
Your Excellency, let me ask you about Saudi Vision 2030. We're more than halfway through, and there are some very notable.
It is Bloomberg Brief. I'm Manus Granny alongside Danny Berger here in New York. To the Qatar Economic Forum, it's underway in Doha, and the event brings together government officials, key business leaders from around the globe to explore the issues driving the boardroom conversations and the challenges ahead. Jennifer Zabazaja is on the ground at the conference. Jen, good to see you. Shame not to be there this year, but geopolitics must be front and center. You've had the Polish Prime Minister, you've had the Qatari Prime Minister. What is the roadway to a de-escalation? How much of that is absorbing this morning's conversation? How are you?
Yeah, morning to you, Manus and Danny. Yeah, I mean, that's really dominating a lot of the conversations that we've heard this morning. You talked about the Polish president who we heard from. We also heard from the Qatar prime minister, who, of course, Qatar has been very involved in potential negotiation talks as pertaining to the Middle East. And what he said that the talks had actually hit a stalemate, which I think was a surprise to many people over the past few weeks, considering Qatar's position. But yes, of course, geopolitics is front and center here at the Qatar Economic Forum. But there's also a number of issues that a lot of countries are facing here. There are climate emergencies. There's also, of course, economic debt distress that a number of African countries where I live are facing. So these policymakers, these leaders, these CEOs are really trying to convene and talk about what are some of the solutions that they are coming up with, and how could they potentially work closer together instead of working in bilateral and on their own terms.
Okay, Jen, great to see you. I look forward to the next couple of days of broadcasting and panels. And speaking of which, let's now give you a little bit of a taste of what's going on at the moment. We have the Minister of Finance for Qatar, along with Al Judaan of Saudi Arabia, and the Chairman of the Islamic Development Bank in conversation with Jumana Besechi.
Only in the past 7 years, we moved from 10% to about 37%. That's significant. Our non-oil GDP has now reached the stage where it actually represents about 50% of our economy. Our unemployment, when we started Vision 2030, was about 12.3. Today, it achieved actually the target for 23 of 8%. Now it is 7.7. We are very close to our 2030 target of 7%. Women participation, you mentioned, we had a target of 30% by 2030. We achieved that in 22, and we are moving now to 36%, and we upgraded that target. Employment in the private sector, because generally in the GCC, governments used to be the employer, the key employer. That is changing. We have 2.3 million employees now in the private sector, the highest ever in the Saudi history. And I can go on, but there are real serious results that are giving us clear momentum. We are not complacent. Obviously, we need to push through the momentum of reforming and transforming the economy, but we see the results. The last point you mentioned, and I'll try to be as short as I can. Obviously, when we started, we did not have COVID. We did not have inflation. We did not have incredibly high interest rates around the world and cost of funding. We did not have the war in Europe. We did not have the war in the Middle East. We did not have the disruptions in the Red Sea. We did not have the disruptions in the supply chain. And that then, all of these collective shocks that are facing the world calls us also to reprioritize, to look at what we are doing and how can we actually optimize what we are doing, optimize our plans. It's not actually the funding that is the constraint. The funding is one part, but it is not the part, to be honest. It's actually the economic leakage. Because if you spend under the current circumstances of serious inflation pressures around the world and serious increasing cost of funding, you are just going to cause two things. One, more inflation and overheating your economy. But second, which is also...
And you can continue to watch this conversation and others at the Qatar Economic Forum live go on your terminal. Okay, coming up, diamonds aren't forever. Anglo American is planning a massive restructuring to fend off its rival. We're going to have more on that next here on Bloomberg. Anglo American is exiting its diamond business to become a copper giant. The CEO says that he expects the massive restructuring to last until the end of next year as the British miner attempts to fend a takeover from its rival BHP. Brian Wingfield of Bloomberg joins us now from London on more. So, Brian, what are they selling and how does this help them prevent a takeover?
Well, what's happening here is BHP wants Anglo because of its copper business. Copper is a key metal for the energy transition, so this is something that's very valuable to any mining company. Anglo is a bit of a conglomerate that's got a lot of components to its operations. So what it's doing to fend off the takeover bid is saying something that investors have wanted for some time, which is to streamline some of its operations and exit its diamond and platinum and coal mining businesses.
Okay, well, the stock is reacting this morning. There you go. There's Billy's down 1.6% and Anglo American also a little bit lighter. This battle is not done yet. Brian, thank you so much, Brian Wingfield, there on the Anglo American BHP saga. Coming up, much more coverage from the Qatar Economic Forum in Doha. Context matters on Bloomberg. Good morning from New York.
From our global headquarters in New York, I'm Danny Berger alongside Manus Cranny. Let's set your agenda.
President Biden hikes tariffs on a wide range of Chinese imports in an election year bid to bolster domestic manufacturing and critical industries. Anglo American exits its diamonds and platinum business in an effort to defend the takeover bid from the rival BHP. Plus, the Qatar Economic Forum kicks off in Doha. We have an exclusive conversation with global leaders and businesses and government. Danny, good morning.
Manus, markets are unmoved this morning, and why would you be? We get PPI today, CPI tomorrow, then we get retail sales. Not to mention we get some individual company earnings of the retailers sprinkled in there. So stocks unchanged, U.S. 10-year yields unchanged. Yen, this is also unchanged, interestingly, because the bond market is moving in Japan. 10-year yields are at their highest level in nearly a decade. But the yen, again, isn't reacting to this. The reaction is that Japan might do what they did earlier in the week, that is cut some of their bond sales. Man, is perhaps the most interesting thing in all of these markets is the return of the meme stocks. GameStop yesterday up some 75%. I think it's up again this morning pre-market, something like 40% to start the show. Manus, I love this because it's so stupid. We were talking with Marvin Barth earlier this morning, and it was just all doom and gloom and so depressing. I kind of like the return of the silly meme traders.
No, listen, Marvin was fairly doom-laden in terms of geopolitical risk. We've had more tariffs announced this morning, which various people have said is a little bit more of theatre rather than actual impact. But you're right, GameStop is roaring. Let's have a look at some of these stocks this morning. So we've got AMC up 42% at pre-market, and you have GameStop up another 43%. And this all goes back to, I love this, what is it, Roaring Kitty?
Yeah. For those,
she doesn't mean Roaring Kitty impression, by the way, but we won't do that on TV.
Please don't make me do that, man.
I won't make you do that.
For those who are unaware, basically Roaring Kitty, how do I describe this? He posted a meme of a guy going like this to going like this with a little gaming.
So this is Keith Gill.
Yeah, Keith Gill, and basically he had been silent for a while, so he's come back and everyone's trading this. And look, the thing is you could say, okay, are we back in the euphoria era of 2021? I mean, we're not. By any stretch of the imagination, consumer sentiment is in the gutter. People don't have that pandemic money anymore that they can gamble with. So it is different this time. In the general environment, people are back at work. But it is interesting, nonetheless, the firepower that this man has, literally just by tweeting one thing.
I mean, if Roaring Kitty told me to go and actually, call my financial advisor, I would believe Roaring Kitty.
You do the Roaring Kitty trade, Manus.
I mean, I want to put it in context. GameStop in 2021 surged by 2,000%. So we're talking about 110, 115%. It's a rounding error at the moment. So we'll keep an eye on those stocks for you through the morning, that's for sure.
Yeah, well, the other thing we have to keep an eye on, Manus, is we've been long awaiting, you mentioned this, the announcement of tariffs from the Biden administration. We have it. Biden's going to be giving a speech today on Tuesday where he lays this out specifically. So we can get into some of the details. The big picture of this, Manus, though, is a sweeping tariff on things like chips, minerals, and EVs. And it's going to affect about $18 billion worth of current annual imports.
And I think for context around this, we did some great reporting over the weekend. The electric vehicle imports from China, a tariff 102%, but you can't really get can't get your hands on a Chinese electric vehicle here. That goes from 27%. Steel and aluminium goes to 25%. Semiconductors doubles to 50% by 2025. Now, we caught up with the Treasury Secretary, Janet Yellen, or I should say Amory Hordern caught up with the Treasury Secretary, Janet Yellen. That was yesterday. China could always retaliate against the steps taken by the US to protect its critical industries. And this is what she had to say.
He believes it's unacceptable, as I do, to be completely dependent on China in these areas. And he wants to make sure, given that China is really not playing by the rules in the sense they have enormous subsidies in critical areas of advanced manufacturing, has resulted in overcapacity. He wants to make sure that the stimulus that's being provided through the Inflation Reduction Act to support these industries, and these are industries that are creating good manufacturing jobs in parts of the country that have been overlooked or have suffered from deindustrialization in the past. The president wants to make sure that he protects these investments. And I don't want to get ahead of the 301 review on tariffs, but this is a commitment that President Biden has made, and I agree with it. I was in China just a couple of weeks ago and made clear that we would not allow Chinese overcapacity to harm our emerging industries.
Does the U.S. want a trade war, though, with China?
We believe that we should have a deep and productive, and that we do in most areas, trade and investment relationship. We're working to stabilize our economic relationship. We do not wish to disengage from China economically, but we do think that the playing field should be fair. And China engages in unfair practices like massive subsidies of industries they've decided are critical. And those are cases where we will act to protect ourselves.
We've seen Beijing in the past, though, respond, and it's become tit for tat. Are you expecting a response? Could they go after Tesla or maybe American farm products?
Well, President Biden believes that anything we do should be targeted to our concerns and not broad-based. And hopefully we will not see a significant Chinese response, but that's always a possibility.
That was the U.S. Treasury Secretary Janet Yellen. And Manis, that's of course interesting, this idea of retaliation, because Biden obviously wants to do this to win points about being a bigger China hawk. But the threat is, does it cause more inflation? And how China retaliates could go a long way to solving that.
Look, a lot of the products that are involved here were products that America had trouble getting their hands on during the pandemic. And if you think about what it is that they're hiking, it's about protecting technology and knowledge, and it's about knowledge and about sending a signal to the Chinese. But it's interesting, the additional things, they raise on pork cranes and medical products, increases on steel and aluminium. So it's part of its theater.
For the unions. I mean, a lot of those you look at and say this is what unions have been asking for, and Biden wants that vote. Okay, Manis, we can't forget either that it's also the middle of the Qatar Economic Forum. It is underway in Doha right now. You're again looking at images of Jomana Bersetchi speaking to various finance ministers of both Qatar and Saudi and the chairman of the Islamic Development Bank Group. That is on Live Go, and we'll have more coverage of the conference coming up.
I think the social peace and the focus on the domestic concerns and the domestic development, taking such a great role in the policies of these governments, is really sending the right signals and augurs very well.
It's Bloomberg Brief, Danny Berger and Manis Cranny in New York. Now let's head back over to the Qatar Economic Forum in Doha, because over there you can see Bloomberg's Francine Lacqua is moderating a panel with the CEOs of the Qatar Investment Authority, Brookfield Asset Management, Franklin Templeton, and the founder of Hill House. Let's listen in.
Main themes or trend. One of them, again, digitalization and AI. And as you know, all economies is going into digitalization, and widely accepted that this is a mega trend that will impact all economies. Two, climate change, which has been, a trendy investment type and theme for all of the investment. Also, I think the growing of the middle class people during the last cycle, a lot of wealth has been accumulated. And this is, I think, a big theme that would impact maybe tourism and consumers. Fourth is the health awareness, especially after the pandemic. There is two aspects of it. I mean, people are looking after their health. And government, after the pandemic, has found themselves that they have not invested in healthcare. So this is, and lastly is the geopolitical aspect and the supply, chain changes. All these themes, I think it will continue for a while. And I think economies will be spending and policymakers will be, focusing on these themes.
Thank you so much. Bruce, what do you see as these megatrends?
Look, I think I'd agree with His Excellency's comments. I'd just say that the trends of decarbonization, deglobalization, digitalization have all probably increased almost exponentially over the last while, especially with the contribution of AI. Look, cloud computing was taking very significant amounts of renewables and data centers capacity 12 months ago, 18 months ago, but it's now taking enormous amounts of capacity. But maybe even the other shift that's happened is that we were in a world 18 months ago where the banks had seized up because interest rates were going up and a lot of money was lost on treasury bonds in the banks. That has abated and capital markets are coming back. So globally, you can now see the markets lifting, transaction activity coming back, and that's a lot different than it was 18 months ago.
Jenny Johnson?
Yeah, so Bruce always talks about his 3 Ds. You mentioned them. I added the 2 other, which were demographics and disinflation. But I think that's been the big change, which, starting in 24, is it going to be 6 cuts from the Fed? Is it going to be 2 cuts? Is it going to be a soft landing? Is it going to be a crash landing? And now there are actually people who talk about whether there would be a Fed increase. Now, I don't think that's the case because I think Powell kind of came out and tried to quiet that. But there's a whole different view, I think, on how long, how difficult it is to tame the inflation. And whether we get 1 cut or 0 cuts or, some number. I don't think anybody was thinking that last year.
Jean-Louis?
Yeah, sure. I would say the biggest change has been the last 12 months. We have seen traditional corporations adopting technology in a massive way. ChatGPT is as much as a great product in terms of technology, but also as a sort of education campaign or corporate enlightenment, if you will, that actually push every single corporation, traditional businesses we own, have to think about how technology changes their business models. I'm really happy to see that traditional businesses now leveraging technology to make it better instead of just the digital gap that we saw in the mobile internet.
And can I ask all of you, is this a good time actually to invest? I know some of you have things in the pipeline. I know you're a longer term investor. Bruce, you've been very acquisitive. Is it ripe actually for acquisitions and consolidation?
So we're in the business of buying things and selling them. So it's always a good time to be buying and selling. But look, I would say when capital is less available in the world, it means there are greater opportunities to put money to work, and odds favor returns being higher when you do it. Coming up, we've passed the bottom of the cycle for PE businesses and real estate and infrastructure. And as a result of that, money put to work in the next 24 months, it will be an excellent time to invest. So the markets are just opening up today. And what that means is that whatever you're doing now will probably be pretty good investments.
Is infrastructure a crowded space? I mean, you were one of the first ones, and now you're seeing more players actually enter that space.
The infrastructure is among the largest businesses in the world. It's the backbone of what everything runs on, and that is, it's just the amount of money that's out there for infrastructure is large, but the need is far, far, far larger. The amounts of money are, I'll say, hundreds of trillions for the things that need to get built over the next 25 years, and there almost isn't enough money to do it. So it's definitely not a crowded space because the needs are so large.
I think it is not crowded. I agree with Bruce. Infrastructure is becoming very important for two reasons. Government trying to get the private sectors involved, whether for more efficiency or for selling and paying some of their debt. So we're seeing that most of the government having their agenda to really sell some of their assets and get the private sector involved in their infrastructure project.
Private credit is also the hot new topic. Questions about valuations, actually, over the last couple of days because of rising interest rates so fast. Can you give us a little bit of a perspective on what private credit in Asia is looking like?
Yeah, I think it's really exciting for private credit in Asia because by and large, the traditional corporates in Asia, they have much lower leverage than their US and Western sort of counterparts, and they actually much more into what I call the real economy. So you look at the businesses, traditional businesses, from department store operator to a manufacturer. So that if you have a good research and sector knowledge, if you can structure it well, I think it's a really amazing opportunity to invest in private credit in Asia.
Do you have anything in the pipeline right now? Is there a very clear pipeline?
Yeah, absolutely. We have probably, I would say, private credit has been we have been most active in this asset class in the last few months, and we continue to see strong pipeline across multiple areas, from healthcare to consumer goods to manufacturing to business services as well.
Jenny?
Yeah, no, I agree, and I think there's a lot of discussion about is there too much money in private credit, and it's not regulated, and is that a concern? And I think the reality is it's just shifted. The credit has just shifted from banks' balance sheets, particularly in the U.S., into the private credit market. In a lot of ways, that can be a better structure because people invest in locked-up capital and vehicles, and you don't have the potential. If you have defaults, you don't have the domino effect of a bank being a counterparty, and arguably in the U.S. also having the government who guarantees a portion of it. So, I mean, I just read something like in the small and mid-size direct loan market, it has dropped from 70% of banks to 11% of banks, and the rest is being filled by private credit. So I think it's a great place to be. And honestly, if you look at for the illiquidity premium, if you could withstand it, you're talking cash at 5%, high yield 7.5%, 8%. High yield is almost priced for perfection in the public markets, and then private credit closer to 12%. That's a pretty good return.
Longer term, Your Excellency, when you look at some of the big challenges, how do you deal with AI right now? I mean, we're talking about investing in the next generation. So you're taking decisions now for something which is still quite difficult to read.
We have, I think we have to admit the fact that AI is still a new technologies. When you draw the spectrum of the AI, you see some of the aspects are very clear. It has a business model, like, for example, the data center, the chips, and so on. And then when we go into the quantum computing, and then the data organization with our labeling, categorization, and then into the software and application, all these are, we are investing in a smaller basis in all of these, but still, if you ask me what is the big winner of this, I don't know. And, when you remember in the internet, during, in the 90s, when the search engines came to the surface, a lot of the names are not existing right now. I remember Alta Vista and so on. So I think there will be a lot of changes. It is not clear where is the big win in AI. But the good aspect of the AI technology is that all of the stakeholders are in agreement to invest more into the space. So you have investors like us, you have the policymakers are keen to attract businesses and investment into this space. And you have also companies who have the know-how, like Microsoft and so. And you know, in technologies, things is moving very fast, and it is accelerating. So it's still not 100% clear where is the big one.
Can I ask you about your strategy of how do you find the perfect time to deploy actually cash?
We are deploying, we are investing, we are continuing investing in the space. But then we make sure that we have a very diversified portfolio into the space. Yeah. So we are in full speed in terms of investing in data center. We are in full speed in investing in data, categorization. We are in full speed in investing in software and application that have a feature of the AI. Yeah. And we are a big player in the chip maker company. So we are investing and we are not stopping. But I'm saying that still
early.
Yeah, the big win still is not very clear for most of the investors.
Brookfield did this mega deal. Can I call it mega deal with Microsoft? I mean, it's a big deal. Is this a template of future deals, of how you structure them?
Yeah, so the deal we did with Microsoft is a framework deal where we're going to build them 10,500 megawatts, 10 gigawatts of power over the next 5 years. And that will essentially be a framework for other things we do with them in the future. And that's about an investment of about $10 or $12 billion. And what's really important to understand today, because everyone thinks about renewables and is it in a bubble, but the important thing to know is that in most countries of the world, the cheapest cost of bulk electricity is solar or wind. And that's dramatically changed from 10 years ago. The cost curves have come down, manufacturing costs have come down, and as a result of that, there's going to be, over the next 20 years, a very, very significant build-out of renewables in the tens of trillions, and that will decarbonize the world. And the technology companies are leading the way because they've all committed to net zero, Microsoft being one of the leading ones, and this is a part of it. But I think it will be the biggest thing today for them to find is credible parties with projects that can build them out and meet their supply. And so we're continuing to do that around the world with great companies like them.
And Jane Johnson, where are you finding the deals? So how do you want to grow Franklin Templeton?
Well, first of all, you asked the question earlier about is it a good time to invest in the market and what is His Excellency doing with his cash? And John Templeton said the best time to be in the market is when you have money. So, and it's because you can find opportunities in anything. So whether it's AI, and I agree with you, I mean, I think the initial AI types of things are picks and shovels, right? It's the chip makers, it's the Microsofts, who are running cloud computing. But the next phase is going to be as companies, and they'll start to differentiate within their own businesses, those who are actually using it to a competitive advantage. And it's hard to see that today, and it takes a while to do that. But I think based on the trends, it's always easier to swim with the current, right? So if your trends, and we talked about the Ds of deglobalization, so it's figuring out who are going to be the beneficiaries of that. In this region, I mean, one of the things that I think is so impressive, obviously, as oil stays high, and it doesn't look like there's any quick resolution to Russia and Ukraine, so it's likely to stay high. There's a mentality of multiple generations, which is something I very much appreciate, and a desire to diversify an economy. And so the various economies, and so you find investment opportunities as there's diversification. And so making sure that you're close, and part of those conversations is where you find investment opportunities.
Yeah, absolutely. If I could add what Jenny said, the settings for investment. Right now, we are, in a very dynamic environment. You could say, whether you worry about interest rates, whether economic uncertainties or geopolitics, seems a lot going on. But we have seen, observed that actually the best companies are built in the time of uncertainties. And the best businesses are actually gaining tremendous market share in economic uncertainties. So we've seen, give you some examples. I talked about traditional companies leveraging technology. One of our portfolio company is one of the largest sort of lady footwear retailer. That they are adopting technology to make the supply chain much more robust, much more nimble, and faster replacement cycles. And they are adopting technology to train their employees so that every employee have a kind of small app that they can train them just flipping page like TikTok, so that every training is breaking down. So that I've seen that companies take advantage of this kind of economic uncertainty, invest in technology, leverage technology to do it better. We had another company, it's traditional business, a mattress company, one of the premium mattress company that in China that had difficulties, during the real estate bubble burst and during the, sort of the quarantine of COVID lockdown, that they would have the amazing slogan in the TikTok, basically saying that if you ever got, quarantine with our mattress. So that's really doing very well. They're leveraging technology, access customers, access supply chain in a faster, efficient way.
Jean, what's your investment strategy looking like? So is it still, what's your take on China and fragmentation?
Right.
Is this temporary, or are you looking to tilt towards a more Pan-Asia investment strategy?
Well, Hillhouse had always been a Pan-Asia investor, but what we're seeing in China, that's interesting sort of opportunities actually coming from sort of the winning the losers game. You're seeing companies not long-term enough, not sort of consistent, have really steady hands, actually losing shares. I think what you do is very basic. You just have a long-term mentality, be very consistent, invest in traditional businesses that can leverage technology to be better. I think that's enormous. I'm seeing same thing happening in other parts of Asia that do the same thing. That people are investing for the long term. Have the steady hands. It's almost like this tennis, right? That you're sort of not necessarily the most powerful players win. It's that just avoid sort of unforced errors, have steady hands. Over long run, you're gonna have a better chance.
Well, Lee and I were talking earlier about China and the opportunities of investing there, and you always get asked the question as an American business, how do you feel about China? What are you going to do? And the answer is it's the second largest economy in the world, and often when people out figuring out those trends again, and within China where there's a desire to build a domestic market, and again, a lot of the competition has gone away, that you do find opportunities. It's sort of gone through a lot of its pain with the real estate resetting and other things, and figuring out where those are, I think is good.
I would just say, Francine, that there are many global investors that aren't interested in China anymore, but there's a lot that are. And obviously the local investors have money in China and are doubling down on investing in China. Many of the Asian investors, and in fact a lot of the Middle East investors, the Americans are gone away. Therefore, there's an amazing...
Great conversation there with our very own Francine Lacroix, speaking to the CEOs of Qatar Investment Authority, Brookfield Asset Management and Franklin Templeton, as well as the founder of Hill House. We'll bring you more conversations with global leaders throughout the day from Qatar. And if you've got your Bloomberg, of course, you can catch up on Live Go on your terminal. Leave you with an image of Bruce Flatt. More to come from Qatar. And, of course, surveillance is right up ahead. We'll see you tomorrow on Bloomberg.
Yeah, the prices in China is becoming